To start off with, if there was one word for this year's budget, it would be bold. This budget is quite special because it symbolizes a structural shift around three key aspects. Firstly, there is a significant change in mindset. The government is focusing more on growth over fiscal prudence and doubling down on it with a sense of urgency in how quickly some of these capital investments can stimulate both short-term supply as well as long-term infrastructure output. Secondly, there is a sectoral focus on where the investments are going with clear big bets on healthcare, infrastructure, and financial services. Third, and most interestingly, for the first time, we saw the finance minister present a paperless budget with a Made in India digital tablet. The Atmanirbhar push there, and the statement was loud and clear. So in this video, I will try to focus less on the numbers and statistics and rather share key thematic takeaways surrounding this year's union budget. It is clear that the finance minister has taken a very bold decision of firing India's growth engines not through revenue expenditure but via capital expenditure. The expansionary stance has been welcomed by most people, if not everyone. From increased outlays for capital expenditure, the 20,000 crore equity infusion into public sector banks, the aggressive privatization initiatives, redefinition of MSME categories, rationalization of custom duty, and even a strong impetus to the exports. It is a very holistic budget which is very much in sync with what India needs at the moment, which is growth and liquidity. And I'm pretty confident that this budget will certainly help sustain the gathering momentum in the economy as we come out of the lockdown and help bring the country back to the pre-COVID levels. By and large, I think the message is clear. India, the Indian government, and the Indian infrastructure is again open to business. As we move into the aggressive territory of fiscal deficit, how the bond market performs and how the yields move from here depend on two key factors. One, how much of the capital outlay laid out in the budget actually ends up on the RBI balance sheet, and two, how deftly the RBI can, through their monetary policy, ensure that the markets absorb this infusion and ensure that the structural changes far outweigh any rise in the yields. On the equity front, despite the markets moving into the budget with a sense of trepidation and pessimism, the reaction is indicative of the broad support to the budget from various industries and segments. I think the finance minister was clear that the government will depend on the markets as a key lever to raise money, which is close to about 1.75 lakh crores through the disinvestment programs that have been announced. We already witnessed indices hit an all-time high today, and of course the 5% jump in Nifty is a sign that the markets are taking quite positively to the budget so far. There is a lot of global money waiting to come in, and this budget, along with the gradually improving economic indicators, will mean a significant FDI and fund inflows to aid the government's disinvestment agenda as well going forward. In this context, my good friend, entrepreneur and full-time trader Shreyas will share a few early thoughts on the immediate market reaction to the budget and how new investors could plan their short-term portfolio. We witnessed the biggest budget day gains since 1997, and this has certainly created a lot of excitement, especially among the new investors, who may now want to enter the markets. So what are your thoughts on this? Over to you, Shreyas.
So the market entered the budget session with a very pessimistic view. Now, this wasn't exactly pertaining to the budget itself, but due to global cues and everything that's been happening with GameStop as well as potential new regulations with SEC, the past week has been very risk-off. We've seen heavy selling by FIIs, and as of Friday, the selling was close to 6,000 crores, which is the largest FII sell figure in the past 2 quarters. So this budget was a pleasant surprise. It seems like a very progressive outlook towards recapitalization as well as privatization of certain public banks. This seems to have led to a rocketing in public bank prices. But actually, if you think about it, PSU banks are still trading far below what they were trading prior to the NDA government coming to power. Like for example, when BJP came to power, SBI was trading upwards of 375, and even now we're still about a good 25% down from there. So there seems to be a lot of euphoria, and banks overall benefiting immensely, making a new lifetime high. One of the other contributing factors is during the correction that we saw 1,200 points from the top over the last week, there were a lot of short positions in the market which had to get covered. Now, from a trading point of view, we're clearly in a bull market, and we have been in a bull market for the past few months. And bull markets are not something that lasts a short period of time. As of now, liquidity story continues to play out. So this remains a buy on dips market, and that's where we are from a trading point of view. As far as investing is concerned, this is not exactly the best point to enter with a lump sum capital, but one can continue to do their SIPs, one can continue to have trenched forms of entry. And the only thing to keep in mind is, in a market like this, a rising tide lifts all boats. We are seeing very low quality companies, for example, Bank of Baroda or Canara Bank, which can be considered very low quality, who will have a storm of NPAs coming down the line. Even they moved up upwards of 10% today. So stick to good quality companies and add them in trenches as far as investing is concerned. Thank you.
Well, we've seen a lot of countries adopt the big bang approach of releasing large stimulus packages over the past few months. But I think in the case of India, the government has been quite prudent in waiting for the country to come out of the lockdown to ensure, any form of spending would generate disproportionately positively higher demand and rightfully so spur economic activities. And given that the finance minister's commitment to infrastructure spending will be spread over the years to come, I believe that the multiplier effect on job creation and value creation will also continue to sustain. In that context, I think the timing is quite accurate. While the budget scores strongly on a few factors, I do believe it may have fallen short of expectations in four areas. First, the tourism sector. After being left out of the recent special economic and comprehensive package, the tourism and hospitality industry, I would presume, was hoping for a respite during this budget. With less than 25% of the pre-pandemic revenues, the sector certainly needs a breath of fresh air, and the budget may have just missed that out. Of course, the contrarian view and the government's explanation to this is that the rapid vaccine rollout may drive a faster and more organic return to normalcy in travel and tourism and may help the industry. So it's a wait and watch on this one for me. Second was around the startups. While Finance Minister Nirmala Sitharaman announced the relaxation in rules for the one-person companies, extension of tax holiday by 1 year, and exemption of long-term capital gains for another year, that would be until March 2022. I think there was a bit left to be desired for startups, VCs, and private equity in terms of tax incentives to encourage individuals and corporates to invest in startups or VC funds. Third, while less on the idea itself, my apprehension is around the execution of the bad bank, which has been announced. Post-COVID, banks are of course facing a resurgence of bad assets, and this bad bank will certainly help segregate existing NPAs and bad assets from the healthier ones and allow the banks to focus on a fresh wave of clean credit funding. But it would be interesting to see how the structure and the ownership of this entity would be managed, and if it would serve as an entity for final resolution of bad assets or purely act as an aggregator. Lastly, of course, from a political lens, the privatization move will certainly experience a pushback from both trade unions as well as the opposition, and the government may want to tread a careful path in ensuring transparent communication towards any conflict resolution in this area. So, in my view, the slow 5 year glided path to fiscal consolidation is completely okay, and it should not come as a surprise because of multiple factors. One, I think post COVID, the path to normalcy is still not clear, not just in India, but rest of the world. And there is no denying that we are truly living in unprecedented times. So the additional borrowing or relaxation on the fiscal prudence is certainly validated. Two, this is a very clear and transparent means of taking on fiscal deficit where everything is on the books, so nothing off the books. So that would give the markets and the corporates a lot more confidence as we move into the next fiscal year. Third, which I think most importantly, the government has found a way of achieving all of this by maintaining the existing tax regime and aiming for higher tax collections rather than taking the easier path of higher taxations itself. And in this context, I would not be surprised if the government has already communicated to credit agencies on why this move should not solicit a sovereign downgrade, especially given how other major economies, including the United States, have adopted very similar measures. So, to conclude, as long as the deficit is managed and executed well, the inflationary concerns should hopefully not bother us. It is imperative for India to adopt a solid growth mindset and continue to focus purely on growth over the coming years if we are to stay competitive and resilient. Thank you.